Welcome to the Megacap recap. We got
$700 billion in CapEx for this year, 1.5 trillion in backlog for cloud computing. Everyone's beating and raising to some extent. You have Google with, one of its best days in decades, not decades, a decade and a half, I guess, trading afterwards. Meanwhile, Meta trading down afterwards. Let's go through one by one. Nick, you want to kick it off first with the outlier here of Meta, not a cloud player where people are throwing money at them to do stuff. So what happened?
Yeah, I think Meta is probably the most misunderstood mega cap here, because you have a company growing 33% top line revenue on the advertising business. It's continuing to tick up, accelerating, clearly seeing improvement from embedding AI into the advertising stack. And yet, every time they decide to raise their CapEx numbers, the street gets skittish and tries to sell the name off, successfully in this last earnings, I might add. And I think the reason is when you look at Meta compared to Amazon, Microsoft and Google, well, they all have tremendous, growing, accelerating cloud businesses where they can sell their third-party compute. So when they go out and they raise their CapEx numbers from 150 billion to 160 billion, people aren't as worried that they're not going to be able to fulfill that number. Meta, on the other hand, doesn't have the capacity or does not currently sell compute. They use it all in-house for Meta AI, for their advertising initiatives, to run your Instagram addiction. And yet, I think that is the clear distinction as to why Meta is one of the names that when they go and have been raising their CapEx numbers, the street gets a little worried. That, in
Yeah.
addition,
Ye-
I just want to be make sure I cover all bases here. Meta did, for the first time in a very long time, report that their DAP, daily active people number, that ticked down by 20 million. They did credit that to Iran and Russia. Russia, I think, banned WhatsApp, and Iran, there was obviously an ongoing conflict. So there's a reason that that number ticked down. I think without those, they would have been up year over year. So that was another reason people credited the sell off. But I do think the longer term story around Meta, at least this past few years, has been around that CapEx number increasing and their ability not to sell compute. But you can clearly see the numbers and the return on invested capital. That's the key word you keep hearing in all of these earnings callback. Return
Well, but
on invested cap.
that's the let me interrupt you.
Yeah.
One, I want to lay to the side that daily active person thing because I think it is an interesting data point, but just focused on CapEx. You don't have to do a huge bank shot explanation. You can see last quarter Microsoft reported slower top line growth on Azure because they were reserving some of the compute that they would otherwise on sell for their own internal use. And the market was like, we don't like that. Like, we have so little faith in the return on these CapEx numbers. We want you to take that compute and build it and sell it as quickly as possible. Don't anything downstream of this, we don't trust what's going to happen 2 or a year and a half from now. So anything you're doing that's like investing in this stuff to create future capability for yourself, we definitely don't trust that. And so I think that's the response. Our house view, which I think is right, is that actually returns, yes, returns on selling this kind of compute power to other companies is clearly like a great business. We're invested in the neocloud businesses, but there's an even better business of using this to develop AI capabilities for yourself, assuming you're capable and have the scale and the data assets to do so. And that's the promise of Meta is they're not dumb. Actually, they're quite smart, and they're going to use this to very good effect to, yeah, make their advertising better and kind of to increase monetization and everything else. And it does not surprise me that the street doesn't like it because the street doesn't even like stuff that is obviously immediately on selling useful here. And this is like a little further down the path from that. So that's my first take. My second, I did see somebody post a chart about how kind of like the fall off in meta utilization is happening at, or as in daily active people, is happening at younger age cohorts relative to later. And I think A16Z put it out, and it's like the kids are no longer scrolling or no longer swiping. I don't know what it is. Or maybe it's because they're swiping instead of scrolling and they're going to TikTok instead of Meta. Do you think that that's like just an underlying erosion that the business will face? against which it'll like, just be better at monetizing the underlying users, but we're basically at peak whatever Meta's footprint is going to be.
No, no, I
They're
don't
gonna
think so.
you
I
think they're
think
gonna hook in it's like the anti-tech sentiment of, I think we're past Gen Z, right? Is Gen Z still driving this?
Yeah, we're Gen Alpha, Gen
Gen
Alpha.
Alpha's anti-tech. They're gonna get addicted eventually. Is that your take?
it's not that they'll get addicted eventually. I think Meta will just find a way to entice them with a product that maybe leans into more IRL in real life or whatever they're, currently wanting. And I think the younger generation is also more involved in streaming. You have a huge portion of that younger generation that's watching streaming. So that would be Twitch and some of your other platforms there. But I think an enormous amount of the economy runs through Meta's family of apps, whether it's WhatsApp, Instagram, Facebook. It's really hard to get around it. And I think when you look at what they're doing with AI and even with the younger cohorts, they will match demand. I think really the misunderstood piece here is, oh, well, Meta doesn't have a compelling AI product, right? They don't have the ChatGPT, Claude, or Gemini, right? They're building out Meta
Well,
AI.
they have
They've
something
made some
even better.
progress.
They have the feed that people scroll on for hours and hours.
Well, you
Yeah.
understand that, but I think the broader market does not understand that what they have in their distribution is extremely, extremely important, and their ability to embed AI in throughout the ad tech, into the recommendation algorithm, into the ranking systems, makes those properties that much more valuable. It makes them that much more compelling, that much more engagement. You can see it. I think Facebook total watch time for videos went up 8% year over year in the past quarter because they started embedding generative AI into the ranking algorithm. And so you're seeing this like little improvement, so single digit improvement year over year on video across Instagram, WhatsApp, all of these different properties. But those single digit improvements are on a massive scale of users and advertising dollars. So it is very, very meaningful. I think I've said it on this show a few times. Meta's probably doing more revenue because of generative AI than almost any other company in the world on scale with ChatGPT, on scale with Anthropic, on scale with Google. It's just not showing up directly in their Meta AI product.
Yeah, and they've had I mean, their chatbot things, I don't think they've caught fire with
Right.
anything that is very visibly AI driven, but
But it's
yeah,
behind the scenes is
conceptually,
why.
being able to do advertisements well at scale across a gazillion different demographics and geographies, that's the superpower that AI gives them, and I think there's plenty of reason to be confident they'll deliver it.
And
Okay, let's leave Meta aside since I mean, and I think it remains to be seen if the kids are gonna begin like Insta reeling again
well,
versus
I feel like
whatever it is
this
they're
is like
doing,
the
but
Philip Morris, analogy where it's like, "Aren't you afraid that all the kids are gonna stop smoking?" And they did, but guess what? They love to vape, and that turned out great.
And use Zins,
Right. It's like
and
and it's like
nicotine is still as
yeah,
pervasive as
yeah.
ever. It's like saying entertainment, like online entertainment is somehow going to go away. I just
yeah,
don't
but
believe that.
at the margin, aren't they losing share to TikTok and Roblox and kind of like these other just media?
I think it's an expansive moment. I think entertainment as a whole, like if you're worried that the amount of entertainment hours per day per user is going down, I would argue that it drastically goes up in the next decade. And Meta, even if they lose share, their share is still on an hours per day basis going to tick up because people are going to spend more time entertaining themselves because they have agents doing their actual day jobs.
that's right. Alright,
Yeah.
we gotta move
But
on to the next
the more important thing here is they'll monetize better per hour
Yes.
on
yes.
the user
Alright,
base.
on to
Yeah.
the next
All right.
companies,
Yes.
which I to me, one of the most surprising things as I was looking back at this, it was the backlog to CapEx ratio, and I was wondering, has this really changed? And the answer is no. It's like, is this is this a it's like, are they just spending ahead of something here? And it's no, people want more, and so they're building capacity to meet what people want. And to me, that was somewhat surprising.
Well, you're saying that they don't have like a change in the orders out. So the broader context in total, there's what 700 and something billion in announced capex across those
Yeah,
companies. Is
roughly
that
700 billion.
roughly right?
And then
So
there's
that's across
Right.
Microsoft, Meta, Alphabet, Amazon.
right, and
Those
then
4.
there's
Right.
1.5 trillion-ish of backlog slash, you know,
It's they
RPO.
have orders, but they're not gonna be fulfilled in the next year for
Right.
1.5
Yeah.
trillion,
So you have
roughly.
Amazon, Google, Microsoft. Microsoft has around $600 billion in remaining performance obligations. Google has around 460 billion, and then Microsoft makes up the rest. So that gets you to 1.45 trillion across just 3 companies. So leave Meta out of that figure.
Right. Right. And there that those are deals where it's like I sign you on a 5-year cloud contract. And so, maybe I'm charging you um kind of a third or a quarter of the cost of the data center. And then the and so it's actually kind of like the rental the rentals they have lined up against this capex is 1.5 time or 2 times in excess of what they're committing to on
Yeah.
capex,
A
and so
And we should, yeah, one, let's put the chart in here so everyone can see. But I think these figures, when you look at the context, right? So going back to Q3 of 2025, that backlog figure was standing at 750 billion. So it's almost doubled, just about doubled in 2 quarters. So if you want to
yeah,
talk about an explosion in demand, and that's
right,
on $750 billion. I was saying this to Sam when we were talking before we hit record. Imagine having a product that has half a trillion dollars in demand. That's what these companies are facing, where they have
right,
so much demand because of AI, because of the excess in demand for these chat tools, that they're sitting
right.
on massive backlogs of revenue.
It's interesting. Like if you think about there is the Jensen Dwarkish podcast, I thought was interesting, where they were talking about chips, but also Jensen has this framing that I mentioned last week of like it's a 5-layer cake. You have energy, chips, this infrastructure, then the models, then the applications. And the market is skeptical of all these layers to a varying degree and is slowly getting kind of pulled into believing in at least the 2-year demand story at each layer. And I think it's actually moving up the stack, as in it's like people recognize, oh, we need to build this energy stuff because it's long cycle stuff. And so, they're filling in
Right,
there.
like the
And then the
GE
chips, they are,
Vernova had its boom. It's like the energy players had their boom early, and then you
yeah.
moved up, and then
And
the
then
chips.
and then you go to
Right,
chips, and now it's like, hey, infrastructure, this demand is actually real, and these infrastructure guys are actually committing capital. So it does not seem like that crazy to think the next iteration. You think the model companies are explosively valued now. Like, wait till you see the growth that is enabled by the compute commitments they're making today. As in Anthropic's revenue growth was based upon basically two conservative kind of compute reservation forecasts they had of a year ago. And OpenAI was already aggressively investing in compute. I think you're going to see actually pretty interesting and remarkable. uh,
Well,
I'm going to actually call. I think you're going to see
do
a
it.
surprising amount of revenue growth across Anthropic and OpenAI over the course of the next
Well,
year, even relative to kind of what people's
well, I think
expectations
that
are.
also
demand for revenue.
that happens with product market fit to some extent, because it's like you had to price it low because no one knew what they were doing. They didn't even know what they were
Right.
selling, but everyone's like, "This is something." You get agents start working, and so it's like you get this dynamic going, um, but it's like once people are locked in, right now it's being subsidized to a crazy extent because it's exploration mode. Once you narrow in and you're like, "Okay, here's the."
But it's not being subsidized. This is a
It is being
people
subsidized.
misunderstand the market. No, well, okay. It depends on how you
Certain
think
parts,
about
certain
training.
parts.
Yeah, because
Training,
the
yes.
extent to which.
The consumer
Yeah,
businesses, the enterprise business, I don't think that the companies are pricing at some discount. Why would they? They're out of compute. They're pricing at a premium. They are investing in training that they're not. So again, it's this like, am I selling it to the customer or are you using it to improve the future product? So if you look at the full stack, they're clearly, burning more capital than they're generating. That's why they're raising more money. But if you look at the monetization layer, I think the gross margins there are actually quite healthy, as in software esque, and so it's not people draw this analogy to Uber, and it's like, oh, venture capitalists kind of like underwrote, basically paid for all our taxi rides for a while to get us hooked on the business. And now they finally, after burning whatever, 30, $40 billion, they finally turned cash flow
Just
positive
in time for
after a decade
robotaxi.
of, yeah, yeah, just in time for robotaxi. Here, there is a prospective bet that investing in training resource will yield better products they'll be able to monetize better down the road. We have a point of view on like what the yield is on that, but it's not the same. The taxi rides on these AI agents they're giving us today are not priced less than the cost of paying the driver and
Yeah, yeah,
stuff.
but all I'm saying is it in the similar sense, they are trying to get everyone hooked on it, which makes sense.
which
And
we are.
which people are,
Which we are.
but it's still
We are.
narrow. It's like if we look at the comparison to the 1994 internet, right? On average, people are using this an hour and hour and a half a week. It's like clearly
Right.
that's going up to 30 hours a week, right?
But
And
that's
then if
because
you
you
start
don't you
charging,
y
even if you keep charging the same price, well, that's 20x there, but you can actually charge
Right,
more.
and but that's the thing I'm saying. I'm saying provide the same level
Yeah,
of service 30 times. That doesn't make them 30 times less
yeah,
cash
yeah.
flow generative. It's actually, I think that layer is very healthy in terms of its economics. And if that grows much faster than they're throwing resources at training, then they hit cash flow positive more quickly.
I also think on the enterprise side, you have pricing power if you're a company, because if
Yeah,
you take away tokens and you take away compute from your employee base, you're just going to become extremely unproductive as an organization because your employees are not going to go back to doing this the old way because they
right.
know there's a better, more efficient way of doing things. Like, think about it from yourself. I shouldn't be saying this, but it's like if Claude were down, I'm not going to go do something that I know I can do in 10 minutes when Claude's back up,
I
right? Like,
refuse to
Right.
read.
I refuse to work if these tools are down. Like, I think that is most people right now in the workforce that have gotten to a certain level of adoption of these tools.
Yeah, well, you say it as refusal, but it's also like the ambitions of the projects that you do increases because you have better tooling, and
Right.
so then it's like you could go back to the old way, but then you produce basically worse work, and then it's not matched to kind of like the depth and complexity of the stuff that you were doing, and so
Yeah.
then it's net unproductive
Yeah,
probably.
like, to your point, it's you hear a lot of times, "Oh, this saved me X amount of time in order," like, "It would have taken me 10 hours to do this, and it only took me 2 because I used ChatGPT or Claude." There's a difference in what I'm saying, which is I wouldn't actually be capable of doing this without the tool, right? Like, it's not a
Right.
time saving, it's a productivity expansion because I just wasn't capable of building whatever this example.
Okay, so then
Yeah.
do any other final comments on the cloud players here before we go askew?
Let's skew
All right.
away.
Yeah,
Sam,
skew away.
please.
Nick, any comments on Apple, or do you wanna just we already spoke about it somewhat last week. Anything you wanna say about earnings?
Not earnings specifically. I mean, I think I've said my piece on Apple, so I won't take up too much
Okay,
time. But I
Well,
would just
from
say
the earnings call, this idea that kind of like their computers and stuff are being heavily used to run local agents, I do think is an interesting, they've spent, if you think about the option value they have as a business, it's not just the consumer facing hardware constellation that everybody's kind of trapped in to some degree, but it's also they have developed really cutting edge custom silicon. So, and that custom silicon can be really performant running local models for people. So that having that really high end CPU spec, which and integrated chip basically. Whereas before it was like, well, I have to have that because they've dumped so much gloss onto the operating system that my computer can't even operate its operating system without having all this stuff. But then actually you can use that raw horsepower to actual useful effect now. Whereas before it was just to like have the perfectly beveled, shaded, like translucent corners on your apps. And so I think that's kind of
And also
interesting.
this is a very Main Street take that I think is actually very profound, which is up until 3 years ago, Excel on it's like professional tools on Mac were second-class citizens.
We're worse. That's
And
true.
now the only way you can use any of these tools is on Mac, and then they get rolled out to Android and
That's
windows
true.
later, and I don't think that should be discounted. That's pretty profound for
Right.
the future, I think.
Yeah, but it's also we'll go to, like, deploying to Linux or Unix or whatever, and we'll all have open source
But
hardware, and
that's never
all
happened.
hardware
It's
will go
like
to zero.
it's
I
The
know,
like
it's
future
never
runs
happened.
on the future runs on Mac.
yeah, I do think the future runs on Mac. We'll leave it there. Moving on to the let's skew away before Brett rebuts here. On I was thinking about this as it becomes summer and intern season in cities is right there's this concept of what Nick was saying, right? He's doing things he wouldn't have otherwise done. Is it or is it not a tough market for new grads? But in my mind, it is the biggest opportunity ever for sophomore interns. It's like, why doesn't the layer just compress down to that point where they've already been credentialed? There's no capability difference, I don't think, really now between a sophomore and a senior. And you can hire the sophomore who can for way less, who can then use the tools. It's like, I think there's this I think
Well,
it's like it's not justifiable to have a new grad hire because 'cause you're like, "Okay, I don't know, Brett, you could just do this in 20 minutes if you outsource an agent." But is it worth it for you to hire an intern who can probably do a way more?
I think
I
what you're
think let me
saying
reinterpret what you're saying to because I think what you're saying may be true, but I'm just as in, usually when we've had interns, I think with most organizations, you don't get interns because you get actually productive use out of them. In fact, the cost to maintain them, feed them, clothe them, and pretend that they can do work is higher than the output you get out of it. So the reason reason orgs run internship programs is basically just as recruiting and separating wheat from chaff to then feed into their labor force. You're saying, actually, maybe now you can get productive use out of them because you can give them AI tooling and maybe they can flounder their way to productivity. And there's no, the benefit of actually maybe you don't even want to take on full-time staff. You want like a bunch of like rolling interns who are doing this work for you rather than kind of layering them into your labor force. Is that what you're saying?
Exactly. They are
yeah, why pay a full-time employee if you know an intern can be just as productive with AI tools?
it's
And if the
Yeah.
intern
full-time employee is just gonna
agent
use those
management
tools
layer.
anyway.
So I think there's an interesting dynamic, which is if you imagine, so there's people posting online saying in the future we'll spend as much on tokens as we do on labor, and other people saying that's crazy. And then somebody posted that like with a third of my 2/3 of my startups think it's crazy, the a third of the startups I'm invested in, it's already true. Um, and what that means is an individual acting within the organization actually has a very big expense budget to like basically hire and have staff working. And so because you're like you have a lot of budget allocation at the individual level, maybe you don't trust the intern to flounder around because they'll flounder around not by being unproductive, but by spending, a gazillion dollars on some stupid thing that you'd given them thinking they weren't going to make any progress. And instead it becomes like this very expensive line item that isn't actually that useful.
Yeah. Interesting future. I do think and there's this semi-analysis piece, I think, this past week. I don't know when it came out, but the level of demand is still shocking. Every week, I am more and more shocked at how supply constrained we are throughout this whole cycle.
I think it's
Yes,
small compared to where it will be in 3 years, 5 years' time, even by next year.
Okay, so then
Like, as this
yeah,
continues to diffuse into the economy and more workers, you're just never going back. You're never going back. It's
I
like,
agree.
why would you walk to the grocery store knowing you can take a car?
I walk to the grocery store sometimes, and I live in LA. So
yeah. Well,
why?
That's because your
Because
no, it's
gas
like why would
prices
you
are
walk to
like
the
$9 a
why are you
gallon.
walking to the grocery store when you can pay DoorDash $15 to walk it to you?
Yeah,
yes, this is
exactly.
true. I do that too.
Okay, things we've got only a few minutes left here. Things that we've mentioned in the past that have kind of blown over, um, and are no longer the highlight, so maybe they represent danger or not. MicroStrategy and leverage in crypto. It's like that was a cycle where everyone got afraid, and it seems like we've moved past it without anything bad happening. Um, there was the
So far.
so far. Well, that's what I'm saying. It's like now something can happen because people aren't looking. It's a watched pot never
Well,
displays hidden leverage.
yeah. Instead that all of the like, a lot of DAT spun up and died, but yes, MicroStrategy remains a concentrated holder of Bitcoin, and they complexified their capital structure in a way that I call it looms out there. Maybe it didn't happen this cycle. One cycle will end with a huge blow up there. Maybe it wasn't this cycle, and it's just, you need the next cycle for that to occur.
Any other things come to mind? I know it still could play out, but the incremental spending for data centers from the Middle East, and that probably still has to shake out. But that was a big fear that I think people have said, okay, revenues are coming in.
There's been some evidence that the Saudis have been pulling back on random stuff, right? Like they are pulling out of Live and they are no longer building their giant line city. Maybe that's idiosyncratic to them. I think that I saw an estimate for, it's something like 50 billion in damage from the war that needs to be rebuilt outside of Iran, which is clearly much more damage. If that were the number, I think it's stomachable. Um, and not that. I mean, it clearly will change their asset allocations in some way. So at the margin, it probably is hurting to kind of funding the marginal Lucid EV manufacturer, but not so tremendously extreme, assuming things continue to be roughly stable out there.
All right. This was a good, quick Megacap recap. We'll see everyone next week.
ARC Investment Management LLC is an SEC-registered investment advisor. ARC, Wolf Financial, and Public are separate, unaffiliated entities and do not have a relationship with respect to any company marketing or selling the products or services of the others. ARC, Wolf Financial, and Public make no representation or warranties regarding and expressly disclaim any responsibility or liability for any acts, omissions, losses, or damages of the other entities or their affiliates, officers, employees, or agents. No company shall be liable for any indirect, incidental, consequential, or special damages arising out of or in connection with this podcast or its contents. The information provided in this show is for informational purposes only and should not be used as the basis for any investment decision and is subject to change without notice. It does not constitute either explicitly or implicitly any provision of services or products by ARC, and investors should determine for themselves whether a particular investment management service is suitable for their investment needs. All statements made regarding companies or securities are strictly beliefs and points of view held by ARC and/or show guests and are not endorsements by ARC of any company or security or recommendations by ARC to buy, sell, or hold any security. Historical results are not indications of future results. Certain of the statements contained in this show may be statements of future expectations and other forward-looking statements that are based on ARC's current views and assumptions and involve known and unknown risks and uncertainties that could cause actual results, performance, or events to differ materially from those expressed or implied in such statement. ARC assumes no obligation to update any forward-looking information. ARC and its clients, as well as its related persons, may, but do not necessarily, have financial interests in securities or issuers that are discussed. Certain information was obtained from sources that ARC believes to be reliable. However, ARC does not guarantee the accuracy or completeness of any information obtained from any third party.